We are continuing in our series of investment strategies, and today we are looking at the growth investment strategy.
Welcome to the Wealth Nation podcast, a podcast for every mother, daughter, grandmother, sister, and wife, and the men who are smart enough to tune in. The Wealth Nation podcast brings you all you need to know about investments, business, property investments, personal finance, and all around financial wellness. Here is your host, Yolanda Rose.
Well, hello, and welcome to another episode of the Wealth Nation podcast. I am Yolanda Rose, financial advisor and wealth coach, and it is my goal on this podcast to give you easy, actionable tips, content, and strategies that you can use to manage your money well and build generational wealth. The Wealth Nation podcast is sponsored by Financial Success Summit 2021. Now, this is a conference that I am putting together. I am getting the top folks in their industry, from property to Bitcoin to formal investments, banking, short-term insurance, budgeting, all of the tools, all of the tips, all of the tricks, all of the strategies that you need to break free financially. I'm getting all these folks together in one virtual room that's happening on the 17th and 18th of April 2021. So if you want to get tickets to this event, go to the website. It's www.financialsuccesssummit.net and buy those tickets. Tickets are selling for just 99 Rand. And if you use this coupon code for a limited time, you can get early bird tickets. So go and shop for tickets. You're going to get a 60% discount and pay just 40 Rand for 2 days of power-packed financial advice. Use coupon code early bird at checkout. This offer expires on the 31st of January 2021. If you're new here, please subscribe to the show on whichever platform you're listening on. Also, link up with us on our various forms of social media as well. We're on all the major platforms. Our handle is Financially Fabulous Females. So we're looking at growth investing today. And for since last week, we started this little series on trying to understand or attempting to understand the various strategies that we can deploy with our investments, be it unit trusts or shares. And today we're looking at an opposing view from the value strategy. We're looking at growth investing. So when it comes to shares and investing in shares, it's not as complicated as all of maybe a stockbroker would lead us to believe. Anyone can build a portfolio that's tailored to their particular investment needs. So growth investing is a very popular style. And in this episode, we'll take a look at the various steps that you can take to take advantage of this type of strategy. So if this is the first time or that you're listening to us and this is the first episode that you're catching, I highly recommend you go back to our previous episode and listen to that episode where we spoke about value investing. So you're seeing everything, you're seeing the comparisons, and as we're progressing with this series.
Raising financially savvy children involves teaching them a variety of skills, from budgeting to planning to earning and saving. Besides giving them an understanding of the value of a rand, it prepares them for real-world finances. Financial literacy is a vital skill, and it is never too early to teach your kids about money. Many parents wonder how they can teach their kids about money and where to find age-appropriate resources. You can now purchase the Financial Literacy for Kids workbook, which is aimed at primary school kids. It's now available at www.financiallyfabulousfemales.com. This workbook provides you with 12 lessons, activities, lesson plans, discussion points, and quizzes that you can use to test your kids' knowledge. Shop now at www.financiallyfabulousfemales.com.
Like what you hear so far? Make sure you never miss a show by subscribing on Apple Podcasts, Spotify, or Tuned In. Now back to the show.
So let's try to understand what growth investing is and what it isn't. Well, this approach refers to buying shares attached to businesses that have really attractive characteristics that their rivals lack. Now, this can include things such as market leading growth rates, for example, in sales or in earnings. And they can also include more qualitative factors such as a strong customer loyalty, a valuable brand, or a formidable competitive mode. Growth shares tend to hold promising positions in emerging industries or niches that feature long runways for expansion ahead of them. And a good share that for me fits the model of a growth share would be something like Tesla. I mean, electric cars have been around for a while, almost 20 years or so. But it's becoming more mainstream now. People are more geared towards it. It's on that upward curve. If you know the marketing cycles, you get the yuppies that try things first, and then a product will gain more acceptance. And um, electric vehicles are gaining more acceptance, even in the United States. And the United States are all about those big American muscle cars, big Jeeps, big family cars, but they're becoming more in tune with the environment and they're openly accepting electronic cars. And electronic cars as well have changed. They're not these ugly Prius types anymore. And if you look at Teslas are really beautiful cars. And performance wise, they match up to petrol engines as well. So that's a great example of a growth stock right there. Now, because of this desired potential in a growth stock or growth share, they are unusually strong in success the business had in recent years. A growth share is priced at a premium that reflects the optimism that investors have in that company. And we see all of that in a share like Tesla. The growth model contrasts the value investing model, which focuses on stocks that have fallen out of favor on the stock exchanges. Whereas these stocks have lower valuations, they reflect more modest sales and profit prospects. Both investment strategies can work if applied consistently, but investors usually gravitate towards one side of the spectrum or the other. So, growth investing is a little bit riskier for two main reasons. Firstly, it involves paying a lot more in relative terms, and so there's a greater potential for the share price decline. For example, Tesla shares are sky high right now, but with the perceived trajectory of the company, those shares could even quadruple in the next couple of years. Second, because there's so much potential in that growth share, the value is predicted on the future gains. Even a small change in investors' perception of that potential could have a very large impact on that share price. So, that volatility, while it generally makes sense to have a minimum 5 year timeline when investing in shares, the growth focused investor benefits from an even longer horizon. So now that you know what growth investing is, you got to understand, is it for you? But let's try and look at the steps involved in fully deploying and getting the best that this strategy has to offer. Firstly, you got to prepare your finances. All right. You make sure all your debt is paid. You have money aside. Money that, remember, with any investment, you must understand the risk that's involved and you can lose everything. You must understand that and you must be willing to accept that. If you're not ready to accept that you can lose everything, you shouldn't be investing. Invest in something a little bit more secure that gives you a more guaranteed return, even though it might be low. All right. But if you're not ready to lose, you should not be investing. One of the biggest mistakes that you can make as an investor is putting yourself in a position to be forced to sell shares during a down period. So, ideally, you'll be ready to buy stocks when most of the others are selling. So, your biggest asset as a growth investor is a rock solid balance sheet of your own. So all of your debt paid off. You're solid, you have some money put away separately. If there's an emergency, you're not pulling money out of your investments to handle that emergency. You have a separate emergency fund. These are the basics, the financial basics that need to be covered before investing in anything, but more especially for very volatile shares. One, you got to maximize your cash flow by cutting your expense and raising your income. Two, you got to build an emergency fund of cash that's equal to at least 6 months of expenses. Three, you got to pay down your debt, especially high interest credit card and consumer debt. And four, you got to have a brokerage account to actually access these funds. Now, if you check the show notes, I'm going to put a link to a broker that I use, when it comes to a share specifically. However, if you're looking for unit trusts and a far broader range of ETFs, you can reach out to me. The link is in the show notes as well, and I can assist you with that. So now that you're on this path, you've got your foundation set. It's time to arm yourself with some other powerful tools that will help you master this investment strategy, and that is knowledge. After all, there are a few flavors of growth investment strategies that you can choose to follow. You can focus on only large, well established businesses that already have a history of generating positive earnings. Your approach could be highly analytical, such as looking at various measures such as operating margin, return of invested capital, and compound annual growth. And you got to go looking for these kind of numbers or statistics to understand what you're going to be investing in, to understand what kind of share fits into the category of a growth share. On the other hand, many investors or growth investors aim to purchase the best performing businesses around, as evidenced by their consistent market share gains with a less of a focus on share prices. So it often makes sense to focus your purchases in industries and companies that you know particularly well as well. So, whether that's because you have experience, say, in the restaurant industry or working on a cloud software business, that knowledge will help you evaluate investments as potential buy candidates. It's usually preferable to know a lot about a very small segment of the companies than it is to understand just a bit about a wide range of businesses. A very popular growth investor was a guy called T. Rao Price, and he's seen as the father of growth investing. And even though he retired from the field in 1971, he's got a major influence in the investment industry and in this strategy specifically. Price helped to popularize the idea that a company's earnings growth could be projected over many years, which shifted investors' thinking at a time when shares were considered cyclical, like it goes up and it goes down and it goes up and it goes down. Now, in our last episode, we spoke about Warren Buffett. He is the ultimate value investor, but there are some elements of his approach that that mimic the growth variety. Buffett once said that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. In other words, price is an important part of any investment, but the strength of the business matters as much, if not more, than the actual price of the share. So now that you've looked at the numbers, it's time to start selecting some shares. And part of this process starts with deciding just how much of cash you want to allocate towards the growth investment strategy. Now, if you're brand new to this approach, it might make sense to start small. Let's say 10% of your portfolio funds. And as you get more comfortable with the volatility and as you build up experience investing through different types of markets, this ratio can increase. So, risk play a really big part in this choice as well, since growth stocks are considered more aggressive and therefore more volatile than defensive stocks. That's why it's important for you to have a longer time horizon, which generally allows for more flexibility to tilt your portfolio towards this investment style. The easiest way to gain exposure to a diverse range of growth shares is through a fund, like an ETF or even a unit trust. And many retirement plans feature these kind of growth options, especially when you're a new investor. These could form the basis of your investment strategy. So you want to look for funds that have really low total expense ratios, right? Because you don't want most of your funds going into expenses rather than into your capital investment. In fact, a very popular fund that I always speak about on this podcast is the S&P 500. Here in South Africa, there's a lot of entry points in which you can invest in this fund. And the fund actually focuses on growth-focused shares on the S&P 500, which makes a good option as well. So you don't have to worry about the diversity. You don't have to go and look at all the various measures that we spoke about earlier. You just buy into this one fund and let the asset manager do the heavy lifting. And usually, with the asset managers, a fund like this on an ETF platform, or even on a unit trust platform as well, the expenses are fairly low. So, growth stocks tend to be volatile, and while your aim should be to hold each investment for a minimum of several years, you still want to keep an eye on the significant price changes for a few reasons. If a portion of your holdings has gained as much value that it dominates your portfolio, you might make sense to reduce your exposure by rebalancing your portfolio. If the shares rises above your estimate of its value, you can consider selling it, especially if you've identified other more reasonably priced investments to direct the funds towards. And if the company has hit a rough patch and it has broken your original idea or the numbers that you've projected for this investment, like below the threshold, you might want to sell. Right. So if you want to know more about putting together a growth investment portfolio, reach out. You can mail me at Yolanda at Financially Fabulous Females. We can do a Zoom call and we can look at your investment options, where you can afford to take some risks, and how we can grow and meet your goals in terms of investments and even retirement. All right, so that's it for me on this episode of the Wealth Nation podcast. Be sure to check out Financial Success Summit. Tickets are out, tickets are selling fast. I do not want you to miss your place, as we will be limiting tickets as we approach those dates in April. Some amazing speakers, and I hope to see you there.
Thanks for tuning in. Make sure to visit our website at www.financiallyfabulousfemales.com and sign up for our free investment masterclass.